You find a solid entry and the market moves in your direction. But without a clear exit strategy, you wait just a minute too long and your profit is swallowed whole by a sudden swing. We often treat these swings as random noise. However, every asset has a unique signature of volatility, typically moving in specific point blocks before it decides its next direction. Over the next few minutes, we are going to map these movement blocks. We will use them to build a visual guide that automates your entry, your exact stop loss, and your exit targets. Consistent trading isn't about predicting what happens next. It's about aligning your positions with the market's internal structural logic. To visualize these boundaries, we use the Smart Renko engine. This indicator is designed to filter out market noise and focus exclusively on price movement. This is inherent volatility, the specific points an asset travels before changing direction. Manually input the 7-day average true range or use auto percentage to let the engine determine it. It then plots exact boundaries for the current movement block. This is critical because a stock like ITC might move in 6-point blocks, while Bank Nifty swings in blocks of 400. Using the wrong range leads to immediate losses. Defining the asset's specific range allows you to set your expectations based on facts, rather than being surprised by a sudden volatility shift. Now that the boundaries are set, we need to ensure we are moving with the larger market current. We only look for entries that align with the broader trend. The 200 exponential moving average is our primary filter. Above it in the green zone, we look for buys. Below in the red zone, bearish pressure. For secondary confirmation, wait for the fast 10 EMA to cross below the 30 EMA while remaining red. This is a strict rule. You should never execute a position if the price action and these moving averages are in conflict. These averages provide a mechanical filter. They require the market to prove its direction before you commit your capital, which helps prevent counter-trend entries. With our macro trend confirmed, we look for the entry trigger. Use a 5-minute or 30-minute time frame. The 1-minute chart often contains too much noise for this specific setup. We are waiting for a negative brick, a red Renko bar, to form once the EMAs have aligned for a short position. As soon as that red brick forms, you enter. Your stop loss is placed precisely at the high of the preceding candlestick. Unlike arbitrary stop losses that traders set based on emotions, this model uses the immediate price structure to define your risk. By systemizing your entry and stop loss, you know exactly what your risk is before the market even begins to move. We are protected on the downside. Now, we return to that initial range calculation to determine exactly where to take our profits. The indicator generates targets automatically. The first is the 44% line to take initial profits. The second sits at the 50% midpoint, where price often pauses. Finally, monitor the 66% zone. If it bounces, the move is exhausted. If it breaks, the trend reverses. Having these specific exit lines plotted on the chart before you enter gives you a significant psychological edge. Knowing the exact mathematical exit points ahead of time changes how you manage the trade, replacing guesswork with preset targets. This process changes how you view a chart. What looked like a chaotic mess is now a structured visual map defined by volatility and trend. This system is universal. Whether you are trading crypto, equities, or major indices, the rules of range and momentum remain the same. Before applying this to high leverage options, practice the setup on standard cash equities. You need to see how the price interacts with these range boundaries in real time. To get started, you can find the link to the Smart Renko engine in the description. Use it to map your next trade and follow the market's internal architecture.